What is up, everyone, and welcome back to the channel. All right, let's get right into it. The headline that's got Wall Street popping champagne bottles this week is huge. President Trump just declared that the trade war with China is officially over. Trade war over? Yeah, you heard that right. China signed the dotted line, they confirmed the deal, and investors went absolutely nuts. The stock market rocketed to new all-time highs because everyone is hoping this means the economy is about to get a massive shot of adrenaline. But is it really that simple? Is this the end of the story or just the end of a chapter? We're going to break down what this actually means for you, your wallet, and your investments. And stick around, because there's a surprise twist involving our friendly neighbors to the north that nobody is talking about. Let's dig in. The Great Tariff Roller Coaster. Okay, to understand why this is such a big deal, we need a super quick history lesson. Think of it like a really dramatic season of a reality TV show called Tale of Two Tariffs, the before times. Before President Trump, the U.S. had a small 3% tariff on Chinese goods. China, on the other hand, had about an 8% tariff on our stuff. Trump looked at this and said, "Hold on, that's not fair. They're taxing us more than we're taxing them." The trade war. Trump enters the White House and decides to crank the drama up to 11. He jacks up tariffs on China to a mind-blowing 145% on some goods. China, of course, fires back, raising their tariffs on us to 125%. This basically slammed the brakes on business. Imagine your Target, and the cool patio furniture you import from China now costs 145% more to bring into the country. You'd have to sell it for a ridiculous price. This hurt. Because China is our third largest trading partner, right behind Mexico and Canada. The New Deal, where we are now. So what's in this shiny new deal? Well, our new tariffs on China will start at around 30%, and their tariffs on us will be around 10%. Now, wait a minute. Your brain might be saying, isn't 30% still way higher than the 3% we started with? And you'd be right. It's 10 times higher. But for businesses and investors, it's a massive improvement from 145%. And more importantly, it's predictable. The chaos is settling, and markets love predictability. That's why investors are so excited. They see this as the first domino to fall, hoping more deals will follow and businesses will finally feel confident enough to start spending and investing again. Plot twist. Canada enters the chat. But just when you thought everything was sunshine and rainbows, Canada enters the chat. Literally, as the ink was drying on the China deal, President Trump canceled all trade talks with Canada. He said, and I quote, he's terminating all trade discussions with Canada effective immediately. Canada. Digital Services Tax. Why the sudden drama? Canada is rolling out something called a Digital Services Tax. In simple terms, it's a tax on big U.S. tech companies like Google, Amazon, and Facebook that make a ton of money in Canada. Trump hates this and has threatened to announce brand new tariffs on Canadian goods within the week. So we fixed one problem, but another one just popped up. It's never a dull moment. Why your next pair of Nikes could get more expensive. Okay, let's bring this back home. How does all this tariff talk actually affect you? Well, a bunch of reports are saying that the prices of everyday things are about to go up. Take Nike, for example. They just issued a warning saying, hey, get ready to pay more for your sneakers. Here's why. For the last couple of years, even with tariffs in place, companies like Nike have been selling you stuff from their old inventory, products they imported before the crazy tariffs hit. It was like a giant stockpile of cheaper goods. Well, that stockpile is running out. Now they have to start selling the new stuff, the inventory that got hit with those tariffs. And since it cost them more to import, it's going to cost you more to buy. Lower supply, higher costs. You know the formula. That means higher prices. Economists are starting to see this in the data, with inflation coming in a little hotter than expected. Some say, oh, don't worry, it's just transitory inflation. Transitory? Where have we heard that before? Look, if these tariffs stick around, Prices for a lot of imported goods are going to go up. The big question nobody can answer is, by how much? Percent? 20%? Will our paychecks go up to match? That's the trillion-dollar question. How to win no matter what happens. So you have one group of experts saying tariffs will create U.S. jobs and strengthen our economy. You have another group saying they'll cause a recession. Who's right? Honestly, financial opinions are like armpits. Everyone's got a couple, and most of them stink. Instead of trying to guess who's right, I want you to focus on a strategy that helps you win no matter what. And if you've been on this channel for a while, you know the secret. It's about understanding the game. When inflation hits and the price of your Chipotle burrito goes up, who gets that extra money? Chipotle, the company. And who owns the company? The investors and shareholders. Person A pays more at a store. The money flows to the company, which then flows to person B, an investor. Stocks actually love a bit of inflation. It's a strange thing to say, but it's true. As companies charge more, their revenues go up, and their stock prices often follow. The way you win in this system is not by being a worker who hopes their raise keeps up with inflation, but by also being an owner. You become an owner by being a long-term investor, period. This means you have to be willing to ride out the craziness. When the next tariff announcement hits, the market might freak out and drop 5%. A scary recession might come, and the market could drop 30% or more. But here's the key. These are not moments to panic. These are buying opportunities. When everyone else is panic selling their stocks, you're the one calmly buying those same great companies at a huge discount. Think in terms of decades, not days. A recession was in the next 2 years doesn't matter if your goal is to build wealth for the next 20. When you have a long-term mindset, market crashes stop being scary and start looking like Black Friday sales for investors. You stop being the person who panics and become the person who finds the opportunity. Thank you so much for watching. Don't forget to hit that like and subscribe button, and I will see you in the next video.